Hey Money Guy family, it's your host Brian Preston, Bo Hansen, back with another episode of Ask the Money Guy.
That's right, you guys have the financial questions, we've got the financial answers. Go out to your favorite social, use the hashtag AskTheMoneyGuy, or you can go to our website, moneyguy.com, or even leave a question in the comments below.
It's Brian Preston, the Money Guy.
So Brian, today's question is one we get all the time because one of the biggest decisions that people make is to buy a home.
Yep.
And when someone's going to make that huge purchase decision, they often reach out and say, okay guys, should I do a 15-year or a 30-year mortgage?
Bo, this is such a hot button issue. So I can't wait to see what the comments that come from this. But I feel like I first need to set the stage with some stats that I pulled from Everyday Millionaires, which is of course Chris Hogan's book. And this is what we found. 90% of mortgages out there are 30-year mortgages.
So that's a 30-year fixed interest rate mortgage.
So does that mean that's the best? We'll get to that in a second. Only because remember, Dave Ramsey and other advisors recommend 15-year mortgages, but that's only 6% of the market. And then I thought this was interesting, is that the typical millionaire, according to Chris Hogan and their research, pays off their mortgage within 10.2 years.
So if 90% of folks are taking out 30-year mortgages, but then millionaires, who we can assume are decent decision makers, they're actually paying that mortgage off in about a third of that time.
That's exactly right. But it doesn't have to be their first house. I think that a disclaimer is needed, is that it has been confirmed that a lot of these people are probably paying off that second or third house very quickly. I resemble that. I know where that mindset is. So let's kind of jump into what's the planning opportunities and how should you put your mindset to understand which mortgage is right for you. You guys have heard me talk about that. I think people in their 20s, their 30s, while you're building foundational type assets, you might need to think about your money a little differently than somebody who's in their 40s and 50s and so on. And Bo, why is that?
Yeah, the biggest thing is the single greatest asset resource you have on your side is time.
Yeah.
We've done a ton of shows that say for a 20-year-old that's just starting out, every dollar that they can put to work in their army of dollar bills can turn into $88 by the time they turn 65. So the value of those darmies, the value of those soldiers is just so high. You may want to consider stretching out that mortgage and instead employing those dollars to work for you.
Plus, there's a lot of things when you're in your 20s and 30s, you have a lot of things pulling on your back pocket.
Absolutely.
You know, this is when you're going through a lot of life transitions. You're having children. You are making that decision of buying a house. So with that understanding, those two things that we just laid out, I do think for people in their 20s and 30s, a 30-year mortgage may be appropriate because of that additional flexibility, as well as allowing you to focus your priority on building that army of dollar bills for the compounding benefit that Bo discussed.
Yep.
So let's flip the script. Now, because I've had a 15-year mortgage in my life, when does it make sense to have a 15-year mortgage? Well, you heard exactly what Chris Hogan found out in his statistical research and surveys is that the typical millionaire pays off their house in 10.2 years. Well, we know from Chris's research also that the average millionaire happens when they're 49 years of age.
So it's not somebody in their 20s and 30s anyways.
No, it's somebody in their late 40s. So I do think for people who are over 40 years of age, lock in a 15-year mortgage, because here's the benefit of a 15-year mortgage is that more of your money is going to principal every month. You're also probably saving approximately 0.5% interest rate on the rate that comes in. And it's going to tie into exactly that data point. You're going to pay off the house much quicker than if you were the 30-year mortgage.
You said two things right there that I think are worth just re-mentioning, Brian, is that generally speaking, when you do a 15-year mortgage, you do get a lower interest rate than 30-year. One of the things you'll want to weigh when you're deciding whether to do a 15 or 30 is that interest rate differential. You want to make sure that it compensates you for the increased monthly payment.
That's exactly
right. The second thing you want to do is you want to make sure you don't get yourself into a cash flow problem. While you may be really excited about doing a 15-year and getting it paid off quickly, if that's something that's going to cause you to go above what we would consider to be a normal realm of housing costs, and you know that we think your housing expenses should be less than 25% of your gross income, if a 15-year mortgage causes you to breach that, it may make sense for you to do a 30-year, give yourself flexibility, but still plan on paying the mortgage off early if you're at the stage of life where that makes sense.
Yeah, we gave the age as just general guidelines, but I understand a lot of you guys, your income sources are going to be completely different. If you're, say you get a quarterly bonus, so you have great money that you can definitely pay down the house quickly, but it's just your cash flow comes in and ebbs and flows. It's not always consistent. You have to take that into account, because here's the good news. you could have a 30-year mortgage, because a lot of you are probably sitting on 30-year mortgages. There's still great historic rates, maybe 3.5%, under 4%. And you're like, man, it's a lot of cost to go refinance into that 15-year mortgage. You could actually pay your 30-year mortgage like it's a 10-year, like it's a 15-year, like it's a 20-year mortgage. You have that added flexibility if you're in a situation that the fees don't make it worthwhile to do the refinance. And that sometimes happens once your mortgage is below $100,000. It gets somewhat expensive to consider refinancing.
And if you're a first-time home buyer, just remember, when you go to buy a residential property, it's not just the mortgage payment you have to think about. You also have to think about utilities, you have to think about insurance, you have to think about real estate taxes. Make sure you're factoring all that into your cash flow so you really understand the affordability of the home you're buying.
That's exactly right. Good base understanding of housing costs. It should never exceed 25% of your total income, and that does include the taxes, the insurance, the principal that you're paying. And then if you're a financial mutant, like we know most of you listening are, you can even include utilities in that percentage. But there's a lot that we just gave you to digest, guys, but I think that if you understand these basic differences between a 15-year and 30-year, you're not just going to go grab the 30-year like 90% of people do. You'll at least know how to make it a custom decision for you and your family and your wallet.
This is a great financial question. If you have a question you'd like to get our thoughts on, or like us to weigh in on, go out to your favorite social, use the hashtag AskTheMoneyGuy, leave a comment in the comments below, or you can go to our website, moneyguy.com.
Money Guy team, out.